Hi all, welcome to the Financial Forensics course. In today's session, we are going to learn about the transaction life cycle and how data science helps us in various aspects of the transaction life cycle. So before we jump into this session, let's just recollect what was taught as a part of this course. Uh, so in the earlier sessions, the students would have learned how a particular transaction is getting captured in the books, whether the transaction goes into the asset sides or whether the transaction goes into the liabilities side, and how all these transactions come together to form the final balance sheet. So that essentially covers the financial aspect of the course. Now coming to the forensics part. So this is the place where we're going to learn about how different frauds might occur in a particular transaction life cycle and how financial institutions are making use of state-of-the-art machine learning algorithms to fight them. So let's quickly look at what are the types of frauds which might be possible in a transaction life cycle. We would have learned about something called the identity theft, where essentially a particular fraudster will have access to the credentials of a particular credit card, and he makes use of the credit card to make purchases. Or phishing attack, where a customer receives a suspicious link, he clicks that link and the fraudster will take over. Then there's the famous accounting fraud, where a company can overestimate their numbers in the books, which might improve their chances with respect to their overall valuation, or in terms of getting the fundings if it's a startup. And finally, the account takeover, similar to the identity theft attack, where the credentials are compromised by the fraudster. So this can happen during the transaction. I mean, at least most of, be it your identity theft or phishing or the account takeover, they can happen during the course of transaction. And there's one more big attack which goes by the name money laundering. So people would have seen where banks were getting fined from hundreds of millions to billions because of having not a proper system or controls in place to capture suspicious transactions. And the fines are in billions, as I had mentioned. I mean, these are the kind of problems which a financial institution fights day in, day out. One, to protect their customers, and two, protect their branding and name as well. So it is a big problem if the fraud and money laundering controls are not in place for a financial institution. So let's just see an overall view of a transaction life cycle and see where these particular frauds can occur or take place. So this is a high level view which I'm going to discuss about a particular transaction. So every financial institution will have something called their source system where the transaction is getting captured. For banks, it goes by the name as core banking system, where essentially the transaction, essentially who the originator is, who the ultimate beneficiary is, what is the to and from account numbers, and where are the branches located, are some of the details which get captured. So this particular data, where the transaction details and the KYC details and their the sanction and watch list details, so they get captured into their data mart. So essentially this is their starting point where they have access to this entire financial data with which they are going to play around with to identify if any fraud is happening or not. So this entire process of matching this particular transaction with the KYC data the bank has with the sanction PEP watch list, it goes by the name of transaction filtering. So this is a live system. So essentially, if a particular transaction is initiated by a customer and there is a match with any of this particular list, the transaction will not go through. As you can have a demo for any of the UPI apps which a person has. In the transaction message, you can give any suspicious name which you know of in the past. And you can see that it will take more time than the usual time which it takes to send a transaction amount to one of your friends. So that's essentially your transaction filtering system. And a transaction will get blocked if there is a hit or a match with any of these names. So let's assume that the transaction has bypassed this and transaction is good to go ahead with. And the transaction is complete. And once the transaction is complete, the bank will have their money laundering system in place. So they term it as AML monitoring, which stands for anti-money laundering monitoring. So essentially this is a postmortem after the transaction is complete. So after the transaction is complete, they'll be doing monitoring if any of the suspicious patterns are identified. And let's say that they have identified some patterns based on their experience. They will put it into a case, they will file a case, and they'll prepare something called SAR, which is your suspicious activity report on that particular entity, and they submit to the regulator. So on a high level, this is your transaction flow. So one would be wondering where essentially data science is coming into picture here. I mean, in this entire space, where can we use data science? To put it in short, these are the different concepts or areas of data science which are getting used in this transaction life cycle. So we have the entity resolution, we have behavioral based segmentation, we have graph analytics, we have natural language generation getting used to generate reports. There are a ton of classification models which are used, and they have something called sensitivity identification as well. So these are the areas where data science is getting used. So let's see what each of these particular blocks represent and how they are helping in combating the financial crime space. Let's take the case of entity resolution. So what is entity resolution? So let's assume there is Ravi Teja from Melbourne who owns a company Ravi Inc. and it is present in the sanction list of the bank. So it's Ravi Teja from Melbourne owning a company. Now there's a different Ravi Teja, which is me staying in India, and I try to send a transaction, a cross-border transaction to someone in US. An alert will get generated because the name is getting matched with the particular Ravi Teja in the list. And once they investigate this alert, the bank investigative team know that this is not the same guy, and they will release the transaction. But as you can see, a lot of false positives getting generated in the manually written rules. So entity resolution essentially is the concept of identifying these two as different entities. So this entity resolution, this filtering system, the transaction filtering system, as you can see, the problem is occurring because it's grouping together. Now let's assume two people entering into a bank and they have initiated transactions with XYZ Limited and to XYZ Ltd. And let's assume the transaction amounts are $10,000 each. Now, for example, every bank has a system in place where they try to set a threshold beyond which a transaction has to be investigated. So assume that the bank had set a transaction amount limit of $10,000 beyond which a particular entity has to be investigated if the transaction is occurring. Now, if the particular bank's anti-money laundering system in place is trying to combine or do a group by on the name of the particular entity, these two will be treated as separate entities. So they will not breach this threshold which is set in place, and they will not go for investigation. And later, if they are found out that these are money laundering transactions, the bank has to pay a huge fine. So using entity resolution, we can kind of identify these two together, and they can say that they are the same entity. And then when we do a group by, the transaction amount totals to 20K, which essentially is breaching the threshold set in place, and we move on. Basically, that particular suspicious pattern is identified, and it gets investigated. So that's how entity resolution is in place. Essentially, what we are using is text analytics here. So there are multiple ways of identifying it, these particular entities, whether they're same or not. We can have our distance-based metrics, like your Levenstein distance or Manhattan distance between text, or we have something called the NER spacey analysis. Essentially, that's your named entity analysis to identify whether they are the same entity or not. So these are the different text analytics as a part of your entity resolution which we are getting used. And let's talk about the behavioral based segmentation next. So assume a customer at the time of opening his account has given his profession as school teacher. So the bank will kind of group similar professions and create a cluster of customers. Maybe your school teachers or an entry-level IT person, they're all put into the same basket. Assume this particular guy who was classified, I mean, who has given his profession as school teacher, is starting doing transactions in millions. That is suspicious. And these limits or thresholds which I had mentioned, they are set based on the behavior. So because of that one particular person who's doing in millions, the entire cluster thresholds might go beyond this value, where the threshold might jump up to, let's say, 50K, where only that guy gets monitored and the rest of all people are out of the monitoring spectrum. So that's why the banks do a dynamic transaction behavioral based segmentation in a regular basis. That's your behavior based segmentation which the banks do. So here your regular unsupervised learning techniques like your clustering methods are used to perform the behaviors based segmentation. And we do have something called the graph analytics next. So what exactly is the graph analytics part? So let's assume there is a company A which had done a transaction of $100 and it sent to a customer B. So this B customer has sent to customer C the same $100, and this C had done a transaction with customer D and sent the same $100, and this D finally sent to A the same $100. So as you can see, this is a circular transaction. So this is one way of actually concealing that this particular customer A itself had come back and got the same amount back. So this is a suspicious pattern with respect to money laundering aspects. So for example, this particular entity A can show this $100 as an income for it, but in essential it's his own $100 which is sent back and looped in back. So graph analytics plays a key role in building these graph networks which help to identify the suspicious pattern much more easily and quickly. Then we have the cognitive layer data science aspects, where we use the sensitive word identification, which is similar to entity resolution, identifying any of the sensitive words are present in the transaction. And we have natural language generation techniques for the reports which the banks or financial institutions have to submit to the regulators on a periodical basis. Most of them are automated using NLG. And we have a basket of classification models which are in place. So where essentially are these classification models getting used? So for the entity resolution case itself, as you can see, there are a lot of false positives which are coming out, as discussed earlier. Now let's move to an AML scenario, which is a money laundering scenario. So let's discuss an example called rapid movement of funds. So as the name suggests, rapid movement of funds, there will be a single large credit transaction into the customer's account and there will be multiple debits. So essentially, like, a huge amount gets credited to the account, and in multiple debits, entire amount is flushed out. So the bank, so this is a traditional money laundering pattern which was identified, and the bank would have set based on some statistical analysis they had in place. The different parameters which they'll be looking at for this scenario are your credit amount, which has to breach a certain threshold, your debit amount, which has to breach a certain threshold, your credit and debit transaction counts, which have to breach the thresholds, and your final ratio, how much of the amount which is getting credited is getting flushed out. So if these thresholds are breached, an alert is generated. Now assume the first of every month, most of the customers, let's say, have their salary account with this particular financial institution. So their salary gets credited, and there will be multiple debits where they pay their bills, and all these conditions might be holding true. So as a result, tons of alerts are generated, but we all know that they are genuine transactions. So as you can see, a lot of false positives in AML scenarios as well. So the problem with the transaction filtering system and the transaction monitoring system is a lot of false positives, and we have the alerts which are getting generated. We have a highly imbalanced data set where about 95% of them are false positives. And trust me, the industry gold standard in these traditional systems is 15% true positive rate. So to deal with this, we use the classification algorithms which are in place. So to put it in a nutshell, in the forensics part, how the financial institutions are combating the crime space is they have their customer segmentation based on the risk involved with the customer transaction levels. They do a dynamic customer segmentation, and they also do the targeted product sale. For example, a financial institution has multiple credit cards, so the institution should know to which particular customer what product has to be offered. So the customer segmentation helps in achieving the goal. And we have our classification problems. The credit underwriting, essentially what credit underwriting is, let's say the bank has personal loans and the credit cards. And if 100 applications are coming to the bank for applying for both the products, the bank has to make a call. Which of these customers are eligible for the product? There can be a number of factors like the profession, the annual income, the way they estimate the strength of repayment of that particular customer. So a lot of classification problems are involved in building a data set and coming up with a scorecard, which will be discussed as a part of this course, the credit underwriting case study, which will be taught in the subsequent lectures. And we have the fraud models. So fraud models are essentially, let's say, a credit card transaction which can be classified as a fraud. For example, let's say Ravi Teja, that is me, residing in Chennai, has done a transaction at 7 p.m. from one of the at one of the point of sales in one point in, let's say, in Chennai airport. Let's say in the next 15 minutes, if the same credit card transaction, the same credit card is used for a transaction in US, I mean, there's a different geography. I couldn't have flown from, let's say, Chennai airport to US in the next 15 minutes. So that is one of the data point which the fraud teams generally make use of, the location at which the transaction is taking place. So these kind of examples or data points are used by the classification as inputs to the classification models to classify a transaction as fraudulent one or a genuine one. So the fraud models are also covered as a part of this course in the subsequent lectures. Then we have the regular propensity models and the anti-money laundering models, where we make use of the classification models, just like how transaction alert which is getting generated by the money laundering system, whether is it a genuine one or a money laundering one. That's where again classification algorithms are used. And talking about text analytics, so as I mentioned, the risk involved with respect to the transaction filtering and transaction monitoring system with respect to the name matching, that's the entity resolution and keyword matching, which is used and which will be taught as a part of this course as well. So we can use the distance-based metrics to capture text similarity, or we can make use of NER analysis as well to capture the similar entities. Then the banks or financial institutions also have their chatbots. Now, as you can see for most of the banks, for questions or the frequently asked questions, then the chatbot response, because essentially based on the responses in the past, they would have trained the chatbot to respond. And as I had mentioned, for the periodic report generations, people make use of the NLG techniques. And we have the graph analytics, where we can identify the customer networks to identify any circular pattern of transactions. And also, if any of these suspicious transactions, for example, let's say customer A initiating a transaction after going through multiple channels is ending up with the final fraudulent entity. So using this graph analytics, we can simply build the graph and see for that fraudulent entity towards the end, to that node, how many other customers are getting connected. So in this way, data science is playing a key role in the entire transaction lifecycle in identifying and combating different financial crimes and frauds which are happening. So subsequent lectures will give a more hands-on experience with respect to few of these problems which we are trying to solve as a part of this course. Thank you.